Okay, good morning, good afternoon, everyone. Thank you for being here this morning or this afternoon, wherever you are in Canada. So we have a lot of people from back east popping in. I'm Russ Morrison from Tactical Mortgage Solutions. A bit about me is I'm 25 years in the industry now. I've been working on a tech product for the past 3.5, 4 years, which is now being launched to the market. Part of this, the reason for me to build this is kind of why we're here today, is to be more strategic in our initiatives with our clients and ideally win more business at the end of the day by providing a higher level of service. So our goal with this platform is meant to strategically help brokers communicate B2C. So what I'm going to do today is I know that, a lot of us we're having some pains right now. And part of why I put this on is we've been having some success with the system in a certain format. And we know the trend within the industry right now is either taking a 3-year fixed or a 5-year variable. Now, to put it bluntly, I'm in the trenches with you guys. We are getting our butts kicked on some of these 3-year fixed. I know some of the lenders in our space are not being as competitive as perhaps that bank is, which is the blue collar bank that we all think that we all know. So what I'm going to do is I'm going to jump in here. I'm going to share screens and I'm going to walk you guys through how I'm working with clients right now. Okay. So this is the tech platform. It's called Tactical Mortgage Solutions. When I log into my account, there's multiple strategy sessions. In each strategy session, there is a section called Mortgage Product Options. Now, within here, we can compare rates and products side by side. So when I start a meeting with a client, and I'm at the stage where I'm making a proposal to the client. Okay, so before I submit a file to a client, I'll go through the options in more detail instead of just saying, hey, do you want a fixed or a variable? What would you like? I find that the process of communicating a game plan allows me to convert more files into funded files. And what I'll do is I'll start by saying the trend right now is really between the 3-year fixed and the 5-year variable. And I wouldn't, because many are going to ask, what about a 1-year fixed, 2-year fixed, 4 or 5-year? Now, the 1-year fixed and the 2-year fixed, I'll explain is that they're about the same as where the 5-year variable is. And we know the variable is going to eventually start to drop. So I don't want someone locked in there. Now, if we go to a 4 or 5-year term, the challenge that we're all going to experience here is that as rates begin to fall, we're going to get hit with a pretty hard IRD because we know that as soon as the rates fall, they're going to call us and ask us to break that product and go to a lower rate. Now, we all know a bit about bank penalties and monoline penalties and that sort of thing. So when I talk to clients, I'll break it down into either a 3-year fixed or 5-year variable, but I'll give purpose and reason why. Now, what I'll do next is I will go down to the mortgage product options, and ideally this is presented in a format that is via Zoom. And I always try to get all my clients on a Zoom call because it's more personable and you can actually see their reactions and actually collaborate with them. They want direction from us. So in this case here, like if I can't do a Zoom call, what I'll do is I'll follow up with a Loom video to explain basically the proposal and ask them to kind of give some feedback on that. So what I'll end up doing here is I'll walk through a 3-year fix versus a variable. And I just put these guys in here because I know that we're getting a little bit beat up. And like I said, I'm in this with you guys. I'm day-to-day. I have a team. And really the RBC they're being very aggressive. And my understanding is that they don't want to be beat by our industry and that. So what I want to do is help everyone strategically try to do something different. Open our clients' eyes to another option and that. So in this case here, what I've done is I've created a 3-year fix. Now, within the mortgage product options section, there are multiple lenders in here. Okay, so you can add multiple components. I've created a whole bunch in the background. There's TD and so forth in there. So I've created a whole bunch in the background that we can, we have in there. So I'm going to compare, you can see here, there's a 25-year amortization. And I'm going to pop back up here. I created an uninsurable and an insurable just for the sake of comparison. So of course, this is the uninsurable in that. So what I've done here is I'll end up talking to clients and saying, Okay, today we're going to get about 479, and we can adjust this rate because we're certainly seeing lower than that, guys, on the 3-year fixed. If I jump over here, what I can do is the prime rate is this is the variable, and I'm going to say we can get about prime less 0.8, I think is about where we sit right now with that on uninsurable files with Scotiabank. Okay, I'll explain to the client that if we take a variable at this point in time, is we're actually going to lose about $16,000 with the variable. However, I'll begin to discuss the forecast for the prime rate. And when I do that, I'll have all this open on my screen. Now this here, and if anyone wants access to these, reference to these, I'll follow up with it. I'll be following up with everyone after the call in order to give you the recording and so forth. So I'll put these links in there. I'll use the Bank of Canada website, and in here there's a monetary policy, and I'll explain that I've been basically factoring in these rate decreases. So this is directly within the actual Bank of Canada website. So it comes from a third party. It's a credible source, of course, and this is kind of the forecast. So we have seen this here. We've seen the drop in June. We've seen the drop in July. And we're waiting for this to happen. So this is not being updated yet. We see here in the 25th percentile of responses, we see it dropping. So I'll show you this in just a second. And then I'll talk about bond yield. So this is exactly how the fixed or the variable is priced at this point. So I'll spend just a minute here saying this is what is anticipated. And then I'll pop over here to the bond yields. I like the CNBC because it allows me to, it's just easier to read and that. So what I'll do is I'll pop in here and I'll talk a bit about bond yields. And I'll say this is exactly how fixed rates are priced, especially in the 3-year category. And what I'll do is I'll begin to talk about back here in June, as the fixed rates, or sorry, as the prime rate dropped June 6th, I think it was, the bond yields took a fall. They stabilized here, and then here all of a sudden you see them pop up a little bit. And I think that was due to inflation popped up a little bit back then. And I'm talking through this with clients at this point, just to say this is what we're anticipating, and just kind of, it's showing credibility in that we're actually giving them information they can count on. Here, unemployment went up. And then you can see here is we're having some trouble in the economy. And then finally, we have that rate drop in July, okay, and the bond yields fall. So my fear when I talk to the client is that, if we take a 3-year fix today, is we're going to miss out on a lot of bond yields being, falling over in the coming months and year. So my anticipation is when I talk to them is that as the prime rate falls, we're going to see the bond yields fall as well. So they'll end up down here. So part of the strategy when I talk to clients is we can go fixed or we can go variable. However, in this case, it is not a bad idea to ride the variable down and see how things sit in the next 6 months to a year. So what I'll do is I'll pop back here and I'll say, okay, within here is now I'm going to actually factor in those prime rate decreases. So in TMS, what you can do is you can create up to 3 forecasts. Now I've mimicked this here to actually create all the forecasts. So what we're finding here is we're looking at September, we're talking about a quarter. October, we're talking about another quarter, and then we're expecting another quarter. And then we take a break for a bit, but I've done a decrease of about 1.5 to 2% by the end of 2025. So, and you can adjust this and create, multiple forecasts, like I mentioned, up to 3, and you can do a conservative forecast and so forth. But once we add this in and we apply it, it changes the game and it changes the vision. It actually will now show that the variable with these rate drops are beginning basically that we're going to be saving money with the variable. And during that time, we can lock into a fixed rate. Of course, we know that at Scotiabank, if we lock into a fixed rate, we have to do it for 5 years or whatever's remaining in the term. So I'll make sure I let the client know that within, if we do take a 5-year term, say just with Scotiabank as one of them, and this is just one example, is that if we are a year in, we can lock into a rate that's 4 years. If we're 2 years in, we can lock into a rate of 3 years or more. So I'll explain that to them. And at the same time, what I'm doing as well is looking at this payment. We know it's a bit higher. So we can actually show within the schedule that as the prime rate begins to decrease, your payments will decrease as well, but your amortization stays the same. So you can show them that, and you can see here at 2606, we begin to surpass that. So if payments are an issue, then, eventually we will surpass that. So at this point too, what I can do is I can talk about product options, okay, with regards to the product info. So within here, I have a flexibility rating. And what I've done with the variables, I've called this flexible. We know that with variables, we can get it with 3 months of interest. Of course, with the fixed rates, we call that lack of flexibility. So there's info buttons throughout that can talk about it. Now, when I talk about lack of flexibility, I would refer to that to be like a bank penalty or maybe a restricted product or something like that. Somewhat flexible would be referred to as a monoline fixed rate because we know they're not posted to posted, they're discount to discount for their penalties. So once we get in here and I'm presenting this and we decide to go with the variable route, what we can do at this point is now look at it at a different scale. If we're going to go and we're competing with RBC, is I'll start talking about the ARM and the VRM and the difference between the two. So we know that an ARM is an adjustable rate mortgage. So what happens is as the rates fall, your payments will begin to fall. So when I look at that, and this is say that we're looking at RBC, is I can add an RBC in here, and I can show these products side by side. So I'm going to pop in a variable. Actually, I'm going to duplicate this to save us some time. So what I'm going to do, is I'm going to duplicate this, and I'm going to change this to RBC. So what I'll do in this case here, and I had a call yesterday actually with a client. She's actually a physician coming up at RBC. And I got to the point where what I began to do was look at this here and show them the difference between the ARM and the VRM. She'd asked me, well, RBC doesn't have an ARM? I said, no, because she wanted her payments to fall. So in this case here, I'm going to put I'm going to say that prime plus 0.75 is what I've been experiencing for the variable, or prime plus 0.7 to 0.75. If I factor that in there, then what I can do is I can show them that with the compounding being semi-annual over here and monthly, is that this actually creates more interest for the client. Okay, so they're actually paying higher interest with a monthly compounding. If I pop in here, I'll talk about, like I mentioned, is the ARM versus VRM. And I'll say most people in today's market, as the payments are high right now, is they want their payments to fall over time. So I can go back to the schedule and I'll actually show them as, look, the difference between the ARM and the VRM is as your payments drop, or sorry, as the rates drop, your payments will drop. However, you've got to be careful that out of the 5 big banks, 4 of them have VRMs and 1 has an ARM. Of course, that's Scotiabank. Now I'm using this for uninsurable purposes. Okay, so this is just one look at this being uninsurable, but of course we go insurable. We have many different lenders to choose from. If I jump back to here and I show a schedule for the variable, is you can see how the rates drop and the payments don't change. However, you can look at the amortization actually begins to significantly decrease over time. So you've got to gauge with that client and talk about the different products. And it is the process of actually showing them this is the conversion. Okay, so when we do this and we look at this side by side, this is the education that I'm using with clients, that we're converting significantly more clients when we're dealing with 3-year fixed. And we honestly, ethically, I guess we as a team, we talk about the difference between fixed and variable. And, ethically, when we look at this is, what if the prime rate doesn't drop? What if? There's a lot of what ifs in these scenarios. We are here to educate the client, and that's part of our job, to let them do it, to let them make the decision, and we can make suggestions and recommendations. But the challenge, I know that many of us, and I speak for myself, and I'm sure many of us, is we placed a lot of people in variables 2 years ago, 2 to 3 years ago. And we went through a lot of pain with that, of course. The prime rate increased significantly higher than many of us even thought would happen. So when looking at this is we kind of look at the, ethically is, what if we place someone into a 3-year fixed rate, and then in 6 months from now, those bond yields are down to 2.5 or whatever, and the rates have dropped, for 3-year fixed down below 3% or 4%. So I like this option here, is being able to ride the variable down. Strategically, the message is to the client is if we go variable, we can ride the prime rate down and lock in at a lower rate later on for cash flow purposes and so forth. But it gives you the most flexibility with that being said. So with I mentioned within the presentation, I mean, guys, I'm in this with you guys as well. We've taken, business has been challenging. At the same time as our profit margins have dropped a little bit over the past couple of years, of course. We've been selling more 3-year fixed terms and so forth. So this year, of course, we go 5-year, our commission structure is a little bit higher. Ethically, that's not what really delivers this for me personally. But if put in the chat there if you can, is what are you getting out there? I mean, what are you finding is what we're competing against on 3-year fixed rates? I've had 4.79 lately. I've actually had 4.69, a couple brokers mentioning, and even 4.59. But the break-even point here is, we're looking at maybe down at 4.59, and that range is still lower. So I'm getting back, I've had one broker say 4.59, 4.5, but mainly what I'm getting back from clients when they talk to RBC or to other banks is they're getting back about 4.79 in this case. Now, if you're seeing anything different, let me know. I can factor it in, but you can do all of this within the platform. So just to kind of put into summary is, within the platform here, you can compare these products side by side. And the most powerful thing that I've found that has helped us is being able to forecast this prime rate. And that has been a huge game changer for us. So after looking at this, and I mean, this is all subject to qualifying and so forth. But at this stage, we know the clients, we've been through the application, and now we're making our proposal. And we've actually planted the seed probably in the first call or so to talk a bit about, what we do here and so forth. So let's have a look here just at some comments. And screenshots. Scotia 3-year fixed 27, Scotia straight line renewal, Scotia through the bank. Okay. So I've seen low is 4.39. See, thanks, Han. Like that's getting very low. 4.89. So the key here is, okay, so prime is 0.7. I'm going to say this is going to be through Manny. I think that's through probably RBC or something like that, I believe. 4.55 3-year fixed offering client TD yesterday. So this is not meant, let's go down to 4.55. Okay. I want us as a community, as brokers, to actually go through this thing and talk more about strategy. RBC yesterday, thank you. And talk more about strategy. Okay, 4.89. We know we can beat that. And strategically too, is we know that a couple lenders, First Nat, changed their rates. We actually we have a client going to First Nat on there. They dropped their rates at the 65% LTV and stuff. But it's really the way you present this stuff. It's the way that you talk about the strategy is what I'm finding is being more successful. But when I sit down with a client and I collaborate with them, is, you can still see it's almost break even here. And that's the goal here is, what is the strategy? What are we doing to win this business? And what is it that we can do to actually communicate with them, in not a transactional manner but 405 to 420 TD branch. Wow. So guys, this is a way to, we're not going to win every file. This is a numbers game. And how I look at it is, how many leads can I get into a funded file? We're not going to get them all. I know that. And some of these we just can't compete with. I lost a file to CIBC a little while back with a $5,000 cashback, and they went prime +1. Sometimes we can't compete in this space, but we can at least have a strategy and do the best we can, overall. So I'm losing him too, guys, but I'm losing less because I have a strategy. So that's going to cover, guys, everything I want to talk about today. Does anyone have any questions, want to chat, put anything put anything in the chat that I can address with everyone? Anything I can help with at this point. And that's the thing too. Thank you, Priyanka, is, we also too, and when someone says the rate is this, we'll ask them, can you please provide that? Let us know. let us know what you're seeing. You know, can you provide us to that, you know, on paper? Because we can, maybe you call bluff, guys. I don't know, right? But this is a way that we're finding this being, you know, being able to at least come to the table with an option. And I'll be fully transparent. I don't want to sit here and tell you that this is going to save everything. It's the strategy and the communication of the client that normally wins in today's market. I feel like my sales tactics and so forth. You know, I look at education-based marketing, but I think it's the transparency that is what truly will eventually, you know, begin to win us. That gets us business, is the transparency and the actual openness of the conversation with the client. And that. So thank you, everyone. What I'm going to do is I'm just going to pop through here. How do we sign up? I'm going to follow up with everybody after. If you want to do a private demo 101 with me, you can schedule it on tacticalmortgagesolutions.com. I will follow up after this today, Patty. Thank you. And also with the basically the recording and so forth. I know some of you have recorded this. I'm just going to run through here, guys, and checked with MMS directly. Initially, I thought clients bragging. So that's the thing is, guys, I mean, what can we do to win the file the best we can? At least give it a chance. And that by strategy, you meant explain them, options available to them. Yes, and complete. And really the strategy to me, Nazanin, is do we go fixed or variable? If we go variable, this is the strategy, is to ride it down and then lock in later, because those will eventually be basically those fixed rates, for the love of God, guys, should be lower in the next 6 to 12 months. There are more ways here, and just to give a little shout out to Ben Rabideau, is in his Edge Analytics is you can refer to, like I use the Bank of Canada website, but there are many different things you can refer to. Now, this is out of Edge Analytics, the recent details that went out. This is actually, I had lunch with a financial planner yesterday, and I talked to him about the 3-year fixed and the variable strategy. And he said, you know, I really like it because this is basically what he sees on his end is, I know there's a lot going on here, but these are the meetings moving forward, and the actual market has priced in drops, quarter point drop in almost every meeting up until July 2000. Well, I mean, at most of the drops here. Sorry, I haven't had a chance to look in this in great deal because it got popped over me this morning. But you can see the decline here. So thank you, Kevin. It's good, Nathaniel. I'll work on this for everyone. Thank you. Just make sure I catch everyone. Yeah, and that's the thing, Marco, is the variable seekers. But can you change the mind of those people going from fixed to variable? I personally, like I talked about, is it scares me if we go into a fixed and then in a year from now, all of a sudden we have these fixed rates that are, you know, down at 3.79 and that. So, I mean, that's what it does scare me a bit, is recommending that. So that's why putting it into an actual platform and putting it into something where they can see it and it's visual. And what I'll do too is up here, I will actually send this to them. Now, you have the option to do that. This is Wayne Gretzky and Janet Jones, of course, but I introduce my team in here, and I can add realtors and stuff in here as well. So within here, I can send them access and they can get it. I like this for compliance as well, because if anything ever happens, we can go back and say, look, we went through all of this with you and so forth. So I like having that in the background as well. Can you make the screenshot bigger? I will do my best to share the stuff with you, or the stuff and that. So I'll either add it in or do what I can, but this is out of Ben Rabideau's recent article that he had put out, and his information is fantastic. Thank you so much. You're welcome. Okay, if no one has any other questions, I want to thank you guys. Ending this meeting here is, I'm going to do a follow-up recording. I will be doing another webinar in about 2 weeks. I'll put that in the next one. I'm going to start doing webinars every couple weeks. Thanks, Justin. Thanks, Nazanin. And I'm going to cover how we are increasing our conversion ratios by using technology with mortgage renewals. So we handle our mortgage renewals in a certain way within the platform. And in that meeting, I'll focus on this area here, this strategy session, on how I'm getting more. I'm beating more of the banks and so forth, and getting more renewals away from the existing lenders, so we can ideally, you know, get paid again and keep those clients. So I'm gonna do that in a couple weeks. I'll give you guys information on that. I'll also put a discount code within it for 50% off the platform for the first 3 months. So please have a look at that. And once again, thank you everyone for being here, and I look forward to seeing you again in a couple weeks, and please reach out if you need anything. Have an awesome day. Take care.